Hello and welcome to the latest Structured Finance and Focus podcast. My name is Bob Vrchota. I'm the head of the North American CMBS group, and today I'm joined by Adam Ott, who's a senior director in the CMBS group. On this episode, we'll be discussing CMBS new issuance trends, the latest in the SASB and conduit markets, and Fitch's CMBS outlook. So let's jump right in. So, Adam, what is happening on the new issuance front?
Yeah, it's busy, it's active, robust, vigorous, all of the descripting words there. Issuance activity, we're tracking about 20 to 25% of ahead of last year's pace. The first 9 months have been very active, especially in the SASB where we're on a record pace. And on the conduit side, pipeline remains healthy. Closing loans has been tough, especially the first half of the year, which has led to smaller pools. However, the market seems to be warming up and conducive to just an intense rush for the rest of the year.
Yeah, I mean, good point. Speaking about intense rushes, the CRE CLO activity has been up a lot this year. If we take a look back to 2024, there was about 9 billion of CRE CLO issuance, and through the first 3 quarters of this year, we're at 21 billion already. So if you forecast that out for full year, we're likely to be about 3 times higher than last year. And, this is largely due to strong demand and pricing for CRE CLOs, which is leading to a more favorable execution than even warehouse financing at this point. Speaking of hot markets, how about data centers? We hear about them in the news all the time. What's happening on the data center financing front?
Yeah, I think that's a good segment to bring up. Fitch published a new structured finance data center criteria in September, and that's going to cover all data center transactions. So far this year, we've rated 3 of that CMBS style structure, and we rated our first ABS style data center transaction. The data center sector, I mean, the capital needs in that sector, they're expected to be pretty high. I mean, we've heard in the trillions, and as such, they will likely need to tap all possible markets. So not just structured finance, but project finance, corporates, private credit. So it should be a very lively market going forward.
Yeah, so maybe not trillions, but to bring it back to the SASB market, what are we seeing as far as SASB activity? What's hot and what's not?
Yeah, in a surprising, unexpected twist, Office has actually made up about a third of the SASB issuance, and that's both deal count and issuance amount. On the opposite end, hotels have slipped. Historically, hotels are around that kind of 30 to 35%, and that's down to 15% this year. I think from Fitch's perspective, right, we've been most active on, the high quality assets, think industrial, self-storage, multifam portfolios, along with just those top tier fortress quality malls, 1,000+ sales per square foot.
Yeah, you make a good point about being more active on sort of higher quality assets. We continue to be selective and in many cases apply rating caps, which means, no AAA, no AA, for example, on certain SASBs when we see certain structural or asset related risks. And to kind of frame it for you, just think about, Class A office, which is fine in many primary markets, but secondary, tertiary markets, we're still cautious. You think about any assets with a lot of single tenant risk or material roll during the term or dark space, we may consider rating caps. And weaker performing malls or any assets with limited alternative uses, we may quote rating caps. And oftentimes when we quote a rating cap, it means we don't get engaged to rate those deals. But I think, good news is our selectivity is, paying off. I mean, right now we have almost no delinquencies in our SASB book. Although in any given month there may be 4 or 5 in special servicing, it's only about 4% of our rated book, and a lot of times it's just to give the borrowers time to work through some mods or extensions. So non-Fitch rated SASB, just to frame it for you, has about a 7% delinquency rate versus our 0, and a special servicing rate of about 14% versus our 4%. So the non-Fitch rated SASBs are definitely facing 2 to 3 times more stress than Fitch rated SASBs.
Yeah, it's a good point. I was actually just looking up some stats on this, right? And I think from our perspective, we've given some level of preliminary feedback on around 140 SASB deals. And of that, we essentially capped allowing no high investment grade proceeds on 27 of those. So, about 20% or 1 in 5 of the SASBs that are shown to us, we're not comfortable with the high investment grade proceeds on them.
Yeah, I mean that's interesting on the SASB front. Now, maybe circling back to conduits you had touched on earlier, smaller deals. Any other notable trends on the conduit front?
Yeah, I think just to put a little context on the smaller deal comment I made. So the average conduit pool is down about 15% from last year. So the average is coming out around 740 million, and last year was at 865. So that's definitely a notable trend. The 5-year structures, they continue to dominate. It's still roughly around 70% of the issuance has been on the 5-year transactions. We are seeing leverage continue to trend up. The Fitch stressed LTV this year is up about 4% from last year, and that's up about 8% from 2023. So that's been a couple of year trend on the increase in leverage. I will say that the amortization is also up a little bit, maybe not a significant amount, but we are seeing less full IO loans this year than we did last year. Another metric that we look at would be the debt yields. And, if you look across the vintages, it has been fairly flat, maybe slightly down. But what you don't see kind of in some of those high level numbers are the office debt yields. And those have increased notably since I brought up office. Speaking of office, right? The issuers are trying to manage the pools and keep that office concentration lower. So it's been around 20% of the conduit deals have been office product this year. Similarly, retail is coming in right around that 19 to 20% range. And that is down. I think last year it was almost 30%. So yeah, you're kind of seeing multifam exposure is the largest concentration at about 24% of the deals, but it is fairly diverse by property type, even if the pools are smaller. So, when you kind of look at all these trends, right? Smaller pools, increased leverage, credit enhancement is up. It was looking the other day and the credit enhancement at AAA is up about 125 basis points, and BBB minus is actually up over 50 basis points year to date.
Yeah, I think that makes sense. With, like you say, leverage up, concentrations up a little bit, CE be up as well. Maybe flipping over to underwriting, another stat I saw was that the average Fitch net cash flow variance, or what we call our haircut to the issuer's cash flow, is running at about 14.4% this year versus, say, 13.2% last year. So it's up over 100 bips. What's top of mind in underwriting?
I think for office in particular, we continue to just be very strict on our vacancy assumptions as well as our leasing costs. So those are two variables that I think are leading to some higher haircuts. Another new wrinkle in the cash flow for New York City assets would be local law 97. So that's become integral to our analysis. We're estimating potential fines, not just during the loan term, but also into a tail period. And that's increasing our expense assumptions. And then, other items like insurance, we're scrutinizing those trends as we have been. Interestingly enough, some of those premiums seem to have stabilized and maybe even begun to decline in some markets. And then just another quick item, it's maybe not cash flow specific, but we have a increased focus on leaseholds, particularly the shorter term leaseholds, so 30 years or less. And that's where we'll kind of sharpen our pencils and look at a potential NPV analysis on those assets.
Yeah, I mean, that's a good color on some of the underwriting trends. Maybe we'll wrap it up here with some of the outlooks and projections. So, again, big picture, right? Issuance volume more than doubled last year in 2024. This year, like you had said earlier, we're up about 25%. How are we viewing the asset performance going forward in light of all the new issuance?
Yeah, we're clear-eyed. I mean, the performance outlook is deteriorating overall. We're seeing the net cash flow softening from 2024 as revenue growth slows and expenses rise. Um, I think maturity defaults are likely to increase given the headwinds and higher rates.
Yeah, I mean, you talk about maturity defaults. It is a good point. Like 60 plus day delinquencies have interestingly held pretty steady throughout 2025. First three quarters, we're at 3% now. We were at 3% at the beginning of the year. However, I think our forecast, is for the delinquencies to tick up a little bit by year end 25, probably near 3.25%. And then 2026, probably closer to 4%. We do have some large office maturing loans, refis at the end of this year and early next year that may boost those delinquency numbers. So we'll keep an eye on that. Now, what are you seeing on, valuations and rates going forward?
Yeah, I mean, I think valuations, seem to be bottoming out, and any reduction in interest rates by the Fed would help with the refi activity. I guess I'll also just say, new construction and supply is slowing across most property types, and I think the commercial real estate fundamentals should start to improve the next few years.
All right, that'd be good. Well, thank you, Adam, for your insights, and thank you all for listening. For more information on CMBS trends, please visit our website at fitchratings.com.